use, what would you think is the most important thing about performance? Timing. Timing. I mean, certainly they're always talking about, well, should I get in? Should I get out? Should I do this? That's 1.8% of performance. I can run you slide after slide of, I buy the stock at the absolute worst possible time. I sell it at the absolute worst possible time 10 years later, and I made money. People get so caught up in timing, and it is so irrelevant. So the other thing is, what's the hot stock of the day? I was working at home one day, and I had my office phone was being forwarded, and I picked up the phone, and this guy didn't even introduce himself. He just said to me, somebody referred me, and I wanted to call you up and find out, what do you recommend I buy? I'm like, buddy, I don't even know you. I don't know what you should buy. He said, well, aren't you an investment advisor? I said, yes, an investment advisor. That means I know a lot about you, and then I give you some advice. It doesn't mean I give you I don't believe in the hot stock of the day. I believe in asset allocation. So we talked a little bit. I said, I don't think you're exactly our target client. No, you need somebody who's going to lose a lot of money for you by helping you figure out what the hot stock of the day is. And that's not me. I'm not going to do that for you. So he went on to his thing. But one of the things that we know is asset allocation is kind of boring. It's not as sizzly and fun and exciting to talk about. So we don't hear very much about it. And in fact, there's articles out there now that says asset allocation is dead. I just got one in my mailbox. I'm not going to do this. If we have time, we'll come back to it. This is my favorite slide, nobody else's, but just bear with me for a moment. We'll walk you through it. There are 4 different kinds of dots on this chart. And let me show you how the chart works first before we look at them. The bottom of the chart is risk. It's a measure of risk called standard deviation. You don't have to understand standard deviation. All you really have to know for the purpose of understanding this chart is that if I'm over here on the chart, I'm at low risk. And if I'm over here on the chart, I'm at high risk. Okay? This axis on the chart is return. If I'm at this part of the chart, I'm at low return. If I'm at this part of the chart, I'm at high return. Okay? So the way this chart works is low risk, high return. Isn't that what we all want? Okay. This chart is low return, high risk. That's not what I get up every morning and think, I can't wait to take a lot of risk and get no return for it. That's like the worst place you can possibly be. This is high risk, high return, low risk, low return. Okay? And there are 4 different dots. There are blue squares. Here's the blue squares. There are green triangles. Okay, here's the green triangles. There are orange diamonds. Here's the orange diamonds. And there's this one purple circle. So I'm just going to look at, first I want you to just look at, and I'm not going to tell you what these, I'll tell you what they are later, but just hang out with me for one more minute. Let's just compare the blue squares to the green triangles. And if I was reading this chart, what would I say about the difference between the blue squares and the green triangles as an investment? Blue squares have more risk. They're out here on the high risk part of the chart, aren't they? What about their return? Lower return for mostly than the green triangles, for the most part, have a higher return. Not so much this one, but for the most part. And even for most of us, this return might be less than this return, but most of us would rather have less risk, wouldn't we? What about the orange diamonds compared to the green triangles? Higher return, and where are we going on risk? Lower risk. Okay, so green, and then the circle is about. It's not exactly the highest risk, highest return, but it's pretty close. So what are these things? Well, the blue squares are individual assets. Remember, I said I wouldn't suggest that you buy just the S&P 500. This is an example of between 72 and 2006 of buying the S&P 500. This is your return and risk profile. This is real estate. This is international stocks, and this is commodities. So we have 4 asset classes represented here: commodities, real estate, international, and the S&P 500. And people who wanted to invest in the blue squares just decided to buy one asset class. Okay? The people who invested in the green triangles got 2 asset classes. That means they didn't have time in their life to figure out what they were going to invest in, so they just bought U.S. stocks and international stocks, or they just bought commodities and real estate. And they just bought them both at 50-50, and they just kept rebalancing. And that's all they did. And if that's all they did, were they better off than the people who just made one decision? Yes. The people who did the green triangles bought 3 different asset classes. They bought real estate, U.S. stocks, and internationals, or they bought real estate, U.S. stocks, and commodities. And they just bought a third each, and they just kept rebalancing. And that's all they did. Were they better off than the people who bought 2 asset classes? Mm-hmm. And the dot is people who bought all 4. They bought 25% of each, and they just kept rebalancing. And they're about as well off as anybody, aren't they? So what does this slide tell us? This is another way of saying asset allocation is driving 91% of our performance. What also is asset allocation doing for us? It's lowering our risk and raising our return. And why is that happening? Because each one of these asset classes has a cycle, and that cycle is fear, optimism, and balance. And if we decide, if we have a plan, remember we talked about planning, if our plan is to just own 50% of one asset class and 50% of another asset class, and that's what we continue to do. We start off with, let's just say we have a $10,000 account. We have $5,000 in stocks, and we have commodities of $5,000. At the end of the year, we are really good. We never look at our statements until the end of the year. That keeps us sane. We have $4,000 in stocks and $6,000, and I know it wouldn't look like that exactly. But what would we do if we were following an asset allocation model? We're going to own 50% stocks and 50% commodities. We're going to buy stocks, and we're going to sell commodities. Oops. So we get back to our 5,000. Okay. Now what has just happened? If stocks are down, what just happened to stocks? They've had a bad year compared to commodities, and commodities have had a good year. Why are we going to sell when commodities are having a good year? Sell high, buy low. You know, if you listen, what does Warren Buffett say? So, what do we know about investing? We need to sell high. So it's the discipline. Okay? So we have all this fear, optimism, balance. We have all these things going on, fundamentals, human emotions. And if we apply discipline to that, we can actually use those cycles to make money. Because if we have a discipline, then we will be selling assets that have gone up in value, we'll be selling high, and we'll be buying assets that have gone down in value, we'll be buying low. And that's the fundamental thing we want to do to make money. But the beauty of asset allocation was also reducing our risk along the way, because these things have different cycles. And the way I say different cycles, one cycle might look like, oops, how does this work? It might look like this, and another cycle might look more, like this. Whoops, that's not a very good marker, is it? Might be a little more choppy. Some things might have shorter cycles, some are longer cycles. But when we're using asset allocation, we're going to be selling at the top, or close to the top. We're going to be buying at the bottom, because we have discipline. We've inserted discipline into our model. Any questions? So there's all 4 asset classes. Now I showed you 4 choices. This is how we start when we're going to manage our portfolio. We start with, what's our total investable assets here? How much are we going to put in interest-generating investments, or those are loaner assets, or bonds, cash, money market, that kind of thing? How much are we going to put in equities? Once we've made this first decision, how much are we going to have in loaner assets? How much are we going to have in owner assets? Then we pick among the owner assets. Do we buy U.S. stocks? Okay, if we're going to buy U.S. stocks, do we buy large ones, small ones, growth, or value? There's a variety of things just within each asset class that we can buy. Internationals, real estate, same thing, commodities. If we're going to own interest-generating investments, we have to decide whether we're going to own longer term or shorter term, and then we have a variety of things within that. This current decision model in our firm, we are using 14 asset classes. When we get down into these bottom sections, we're using 14 different allocations. But our basic allocation looks like interest-generating investments and equity investments, and then we make decisions within that. And of course, each one of those decisions has a return, a historical return, and a historical risk to it, and we can actually measure that. We can measure the volatility, we can measure the return, and we can measure how it's going to relate to someone's goals. So I can say, here are your goals, here's how you're going to invest, here are your cash flows. How does this work together, and what's my likelihood of success? And I like that because I can